Okay, so we are now ready, or I'm ready, I guess I should say, right, to get into chapter 5. Okay. So I'm going to bring up the PowerPoint because there is a lot of information in chapter 5 that's new, so it'll keep me kind of make sure that I cover everything that we need to go over. And then we'll do a short practice together as well. I just wanted to go over some important stuff in chapter 5. Again, we're shifting gears now. In the first 4 chapters, we were looking at service companies. So, you know, they were providing consulting services or whatnot in exchange for revenues. Okay. So now we're going to look at inventory. So now we're looking at more of a merchandising company. So you're looking more like retail. Okay, so these are companies that purchase goods and then resell them for a higher price. So everything from your big Walmarts and Targets all the way down to, you know, mom and pop operations. Of course, again, in this class, we're focusing on publicly traded corporations, but we still know there's some small retailers, you know, that are publicly traded, and then obviously very large ones. So accounting for merchandising businesses is a little different than service. And some of the biggest differences is, well, we buy inventory. So inventory, and we'll look at this in a minute too, is an asset because we purchase it and it's a value to us and it has a worth. And then we're going to sell it, and that's when we need to cost it out. Okay. So, you know, inventory, when we purchase it, it's an asset, it's a value, and then when we sell it, we cost it out. Yes.
When it is an asset, like let's just say, like at our salon, we buy like hairspray, whatever products. And
Yes.
we buy it for like half and we sell it for whatever. Is the value of that what we bought it for?
Yes.
Okay.
Yeah. Good question. So yes, when you're dealing with the inventory value, you log the price at the price you pay. At cost.
Okay.
And then when you sell it, you're going to cost it out at the cost you pay. Okay. And then your revenue is going to be listed at the price you sold it for. And so then the difference, if you take, which this we'll cover in a minute too, your revenue minus that cost you paid is your profit, like your gross profit or your on that one product. Okay, so yeah. But good, it's good that you can like attach a real world example to it because then it makes sense a little bit more. But yeah, you got it. Let's see. So basically, when we deal with merchandising companies, we're going to deal with on credit. So sales on credit. Just that's how most bigger corporations work. They sell on credit and they bill their clients, and then the clients pay them. So you know, it really is no different than what we've been doing, though, right? If we perform services on account and then they pay us at a later date. So nothing really changes there. We're just going to talk a little bit more about invoicing and how the invoicing side of things work and how we account for it. Okay. So we're going to purchase merchandise usually on account, which would then be accounts payable. And then we're going to sell on account, which would be accounts receivable. And again, the difference is kind of what we were just talking about. We now have an extra cost. So when we're looking at like our income statement specifically, our income statement changes because we have what we call cost of goods sold. Okay, so that's the cost of the merchandise. And again, our merchandise is costed out when the sale takes place. So it's moved out of inventory and to cost of goods sold. So you'll see just a little different structure now. Instead of just having fees earned minus all of our expenses equals our operating income, we'll now have sales, which is our revenue account. It's still revenue, minus cost of goods sold equals gross profit. So again, the gross profit is the profit that you've made just on the sale of that merchandise. And then we subtract out like rent and wages and all the other fun stuff to get our actual income. Okay. So that's kind of the big difference on our financial statements.
So merchandising businesses only merchandise like Walmart, like they don't have multiple forms of revenue, like performing a service or?
Some can offer both. Yeah, you could. You know, they could still like. I think they've gone away from it a lot. I think because Walmart like rents out those spaces, but I think of like Best Buy maybe. You know, they sell and then they have like their little nerd herd or whatever they call them. I can't remember. I think that's from Chuck. Best Buy. I can't remember the Geek Squad. So yeah, like I'm putting like television into real life here. But like they have the Geek Squad, so that's a service, and it's still under Best Buy. So they just would keep them, you know, separate as far as their accounting of revenues. But yeah, they could have both service revenue and merchandising revenue. So again, the big thing here is we have a new account called inventory or merchandise inventory. It is a current asset. So our goal is to buy inventory in the current period and sell it in the current period for a profit. Okay, that's our whole goal. I'm just going to go over the highlights, like I said. We're going to use what's called perpetual inventory system, just in case you hear that terminology. It just means we're going to update our inventory and our cost of goods sold every time we make a sale. So it's actually easier that way. And that allows us to see, you know, gross profit, costs, all of that, and up-to-date real-time inventory. The other method, periodic, it waits till the end of the month to do reconciling, and so you have to go and physically count and see and add up everything you sold, and it's just more work, really. So we're going to do perpetual. So when we purchase inventory, we truly debit that asset inventory in credit cash or accounts payable, which again, we'll see that a lot, okay? So purchasing merchandise is just a simple journal entry. And there they're showing it if we purchase it on account. The only difference now is that you're going to see accounts payable or accounts receivable and then a company name. Well, it's important that we keep track of who we owe or who owes us, right? So all we're doing there is we're going to keep track of each company and what they owe us separately or what we owe them. It's really just kind of adding that extra layer to it. We would do this regardless, even under service, or yeah, service, but it's just now kind of introducing that. So we're keeping track of who we owe or who owes us. So we pay the right people, right? It's kind of important. So now when we purchase merchandise, or sorry, when we sell merchandise on account or when we purchase merchandise on account, we're going to have an invoice. We create an invoice to bill our clients, okay? So we're just going to kind of go over what an invoice looks like, just because it is important. So you're going to have the company, obviously, and who we sold to, the order number, order date, invoice number, the date it shipped, how it was shipped, all of that. The important stuff we want to look at, of course, is the amount. So we sold 20 printers for $150 each for $3,000. And this is the sale price. This is what we're invoicing them. This is what they owe us. But what's important here are these terms. Okay, so that's a big difference for this chapter, is we're looking at, we invoice them on January 5th, and then they have terms to pay it. So in this case, it says 2/10, comma, in 30. The first numbers that they always give you is what's called a discount period. Okay, so that 2 means 2%. The 10 means 10 days. So if they pay within 10 days of January 5th, they can take a 2% discount off their bill. So we reward our clients for paying early. Okay, that's pretty standard in the business world, especially if we order a lot of merchandise from a client. And then the N30 means if you don't pay within the 10 days, the full amount or the net amount is due within 30 days. Okay, so the 2/10 is the discount period. The N/30 is like the credit period. So it's just how long we're giving them to pay it. Okay, and we'll get into in financial accounting what happens when they don't pay in that 30 days and all that fun stuff. We won't dive into that right now. We're just going to assume, we're going to play the fun assumption that all of our customers will pay us on time. So again, those terms are just called the credit terms. And then if they're given a discount, they have that discount period, which is always the first part. And it can vary. It could be 1% for 15 days or 3% over, 5 days, whatever. Every company will have its own discount or their own, rules. And then most are either net 30 or net 60. But some could be like net end of the month. And you'll see like EOM for end of month. There's different ways to write invoices. Okay. But again, we just like to encourage people to pay their bills on time because that means money sits in our account and earns interest. So we'll give them a little bit of a discount to do that. And that goes both ways. So when we purchase the inventory, we're usually getting those discounts as well. Okay. So it kind of all washes out in the end, probably, but it's important. Okay. They're just kind of breaking it down visually. Again, we have the invoice date of January 5th. So then we count 10 days from there. So they have until January 15th to pay that bill and get the 2% off. Having worked in corporate, I will say our accounts payable clerk would get in trouble if she did not pay bills within the discount period, because obviously that's money lost. And also, I know that we would hold the money until the very last day. So we could keep our money in our bank account earning interest until the last day in the discount period. So those are just things people do to keep a hold of money. And usually, honestly, now, of course, there's a lot of electronic payments or quick payments. But if we still physically mail them a check, they usually go off the post date. So if it's mailed on the 15th, then we would still be within the discount. Because obviously, you could get an invoice dated the 5th and not receive it till like the 8th, especially if it's like over a weekend or something. And then you'd have to mail it right out to get it to them on time. So they always kind of look at those post date, when did you actually mail it? So we have until the day of to pay it. And again, life has become much easier with electronic payments where we don't run into that as much. But again, they would have 30 full days to pay it if they didn't take the discount. Okay? And there they're just showing you how they calculated the discount. 3,000 times 2%, which is $60, and then they took that off the 3,000. Another real easy way to calculate it, though, is just if they're getting 2% off, they're paying 98%, right? So you could just take 3,000 times 98. It's a little quicker. You don't have to subtract then. So those are called purchase discounts. Okay. And the way we're going to account for those in this class is when we offer the purchaser a discount, we're just going to go ahead and take the discount off the top. Okay, and I'll show you what that means. So basically, we're going to log, the sale at the discount amount, so that way we don't have to log it later. Okay. We're not going to do examples because we'll do them in a minute. I just kind of wanted to show you that. So here's what the journal entries would be for paying when we purchase something. Okay, so we are the purchaser. So we purchased inventory on account, and again, the discount was already taken off the top. Okay, so we calculate the discount up front, and we're going to log our inventory cost at $29.40, and then we owe them $29.40. And then you'll recognize these are just typical journal entries, right? This is just paying our bill. So that's all the same. Okay, so that's when we purchase inventory. Okay, any questions on that? Okay. Of course, we could have returns. That's kind of the tricky stuff. There's just a few things to keep track of in this chapter. If we return something, we're basically just reversing our entry. Okay, so we would debit accounts payable and credit inventory for whatever amount the return was for. We would want to consider the discount, because we already took the discount off. So we would have to consider that amount. But here, for instance, we returned $900 worth of goods. So accounts payable is debited and inventory is credited because we no longer have that inventory. We send it back. So we're going to use that inventory account to account for those returns. Okay. What's this one showing? So this is just showing a whole process. If we purchased inventory minus a 2% discount, So we debited inventory and credited accounts payable. And then here we returned $1,000 worth of that merchandise. But again, we want to take that discount off of it. Otherwise, we'd be returning more than what we paid. Okay, so we just, reversed that entry for 980. And then when we went to pay them, obviously our accounts payable is now 4,900 minus the 980. So we would just pay them what we owed. Okay. That's if we return it before the bill is due. When we make sales, we have to look at I think the confusing part about this chapter is we're going to look at it both from the purchaser or the buyer and from the seller standpoint. So it gets a little confusing at times. Like you have to think, am I the buyer or the seller, buyer or seller? And as a merchandiser, we're both. We buy inventory and then we sell it. So you just have to think about which side we're on. So now we're kind of just switching gears a little bit and looking at the sales side of it. So again, I already mentioned it. Our revenue account that we deal with merchandising is just sales. Okay, we're just going to use sales across the board. Okay, so if we sold merchandise for $1,800, cash is debited and sales is credited. That's a typical revenue entry, right? Pretty easy. The only part that gets a little tricky is every time you make a sale, there's 2 journal entries. Okay. In addition to recognizing the revenue, you need to show the inventory moving out the door and costing it out. Okay. Remember, we purchased the inventory. Now it's going out the door, right? We shipped it away. So every time we make a sale, there's 2 journal entries. You recognize the revenue, which is how much you sold it for, minus the discount. And then you recognize how much the cost was to us. So cost of goods sold is debited for the cost we paid, and inventory is credited for the price we paid. Okay. So revenue is logged at the sale price, and then cost of goods sold is journalized at the cost.
So basically, when they throw in what they paid for it, it's just to throw you off. Just to basically always revert to the amount that you actually paid.
Yes, yeah. Well, what the amount they paid is the revenue. Yeah, yeah. So whatever they paid is the sales you'll record, and then what we paid is the cost. The difference is the profit. Yeah. Does that make sense? Yeah, that's where it gets a little tricky. If they pay on credit card, it's done as a cash sale because then the credit card company is liable for paying us. So we treat credit card sales as cash sales. And then, of course, unfortunately, we know credit card companies charge us when we process credit cards. So we have to pay those expenses. So if there's the expense of utilizing credit card processing, we just have a credit card expense and a credit to cash. It's pretty easy, just kind of just showing you. But we know that the pros and cons, though, if we take credit cards, or the pros outweigh the cons. Okay, if we take credit cards, again, we're not liable. The credit card company is. So the credit card company pays us, and then they're responsible for collecting. So that collection goes away. It's a cash sale. And then obviously customers are more willing to purchase if we take credit cards, right? I mean, especially in the day we live in. If I walk in and they're like cash only, I'm like, oh crap. It's like, forget that. I don't even know what my ATM card PIN is. So bad. And so the only time I have cash is if I buy something online for my parents and they pay me back in cash. I make cash. I mean, like I'm making, it's my money. It's just, that's how it works. But anyway, the only con really of taking credit cards is there is a small fee. Credit cards either charge like a flat fee per swipe, or they charge like a percentage of the total amount. So that's why you'll see some places don't take certain brands or certain cards, because I think for a long time American Express had really high fees, and so they wouldn't take it everywhere. But I think that's getting a little bit more common where they take all the credit cards, bigger stores. Oh yeah, they charge you a huge fee, right? It's ridiculous. And then, and I was just going to say too, that's why a lot of smaller mom and pop type stores don't take credit cards, or they'll say, you must make a minimum $5 purchase. Because if they're getting charged like 20 cents every time you swipe your card, you know, it's not worth it to them if you're swiping your card for a 99-cent pack of gum. They really are. Because I always say the consumer's the one paying those credit card fees, really. Because, you know, the businesses have raised their prices to accommodate that charge, you know. But that's just how it works. So again, this is just showing us a typical selling. So we are the seller. So we sold merchandise. So accounts receivable gets debited and sales gets credited for the actual sale amount. And then cost of goods sold gets debited and inventory gets credited for the cost. Okay. So again, it's just those two journal entries. It's not too bad. Yeah, it's really not. I think, like I said, the only part of this chapter that gets a little tricky is when we deal with like freight or returns or just like remembering, am I the buyer or the seller? Because other than that, I mean, they're pretty typical journal entries. Again, we can offer them a discount. It works just like our purchase discount did. So really no difference there. We're just going to take the discount off the top. And there are two ways. I mean, this is called the net method for invoicing. Some will wait and do the discount when they actually send the payment in. But this is easier, I think. So we're just taking the discount off the top, just like we did on the purchase side. So that's pretty straightforward. So if we get a problem, you know, whatever we've sent them is defective or damaged or not what they wanted, of course, we will give them a refund. Basically what we do is we estimate at the beginning of the year, or usually at the end of the year, like as an adjustment, how much we think we'll have in refunds, okay? And we put that in what's called a customer refunds payable account. So we just create this liability account. We kind of estimate it, like I said, as an adjusting entry, fun adjusting entries. And think out of all of our sales, we think this much is going to be returned. So we have that amount sitting out there in a liability account credit. So whenever someone actually refunds or, you know, sends something back, if we're giving them their money back, we're just going to debit customer refunds payable and credit cash. And this is when they are keeping the merchandise and not sending it back. So this is when it gets a little tricky. So if they are not sending any merchandise back to us, we don't have to worry about inventory. So we can just debit customer refunds payable and credit cash. So this is like, I mean, I've had that happen. You know, I call Amazon and like, this was broken when it shipped to me. And they're like, we don't want it back, just throw it away or whatever. And we'll credit your account, okay? So this is when, again, that was damaged in shipment. But it could be something else. We sent them the wrong order or something, and it costs more money for us to ship it back and, you know, deal with all of that. So we just give them a refund. So again, they kind of put it backwards, but the refunds payable is a liability. It's just estimated as the adjusting entry. If that was in an instance where they've already paid their bill, so if they owe us, we would just issue them a credit memo. So in that same situation, if we granted them an allowance of $900, but they owed us money, we would still debit customer refunds payable. We would just credit their accounts receivable. So when they paid us, you know, they're not paying us that $900. They're paying us for the merchandise that was good. So it just depends. The first one, we'll give them a cash refund if they've already paid. If they haven't paid their bill yet, we credit their account. So pretty similar to real life too, okay? So this one is when they actually do send merchandise back to us. So they returned merchandise with a price of $3,000 for a cash refund. And the cost to us of that merchandise was $2,100. So since they're actually physically sending us back inventory, we have to account for it. So we would still do the refund, customer refunds payable in cash. But now we're going to debit inventory because it's coming back into our inventory and we're going to resell it. I mean, especially if there wasn't anything wrong with it, they just didn't like what they got, you know? Maybe it was the wrong size or color or whatnot. So we'll just put it back into inventory. And then it goes into an estimated returns inventory credit, which is another estimated account, okay? So those are kind of the little tricky caveats of this, dealing with
this.
this.
Probably been going for a while, have like this kind of stuff, right?
Yes,
Not
yeah.
like anyone that's fresh, because you're not gonna have the data to go off of. I think estimated accounts.
Correct. Yeah, it usually takes you a couple of years. I mean, you might go off of like standard, like you probably look at standard business practices like 5% of sales or something that first year, and then you would adjust every year. So you would still do the estimations, but they would probably be off, and you just
Until you kind of get your rhythm.
Yeah, it's always an estimate, and then there'll be years when you have like maybe your warehouse, are screwed up or something, and so you have all kinds of returns. You just don't know. But generally, we don't worry about those. But yeah, it does. It kind of fluctuates. And then this is just a nice slide as a review, kind of looking at a good one to print off for your notes. If they don't return the merchandise, but they get like some type of credit, or if they do. So that was just kind of a nice one. I like in these slides, you could just print off some of these summary ones and kind of be like, okay, we're giving them money, but they're not sending anything back. They paid cash. This is the journal entry. Okay, so those are kind of helpful. Let's see. I think there's still a little bit more. Freight. It just, when we're dealing with freight, it depends on who's paying the freight. So, just again, like, Amazon, if you have the Prime account, the 2-day shipping, Amazon pays your shipping, right? A lot of times, though, the buyer will pay the freight charges. And if that's the case, if I'm purchasing inventory and I'm paying the freight, it's increasing the cost of my inventory, okay? So freight, if I'm purchasing the inventory, I'm going to add that freight into my inventory, okay? So they're just kind of showing that here on the first one, if we purchase merchandise and paid freight, the freight goes into the inventory cost. So our inventory, that asset, we want all the costs associated with getting that inventory ready to sell. So it will be the cost we paid for the inventory plus any shipping or insurance or anything, okay? Yeah, because it's the full cost of that inventory. So just remember, if you're the buyer and you're paying freight, it's just going to be logged into inventory. And here we paid it, separately, and that's fine. It could be on a separate invoice. It could be to a different company even. Like we could have been billed by the Freightliner company. But it's always going to be an inventory cost when the buyer pays the freight. If the shipper is responsible for the freight, then it just becomes like a freight expense, okay? So just kind of remembering that. Or delivery expense is what they charge it. So if we're the seller and we pay the freight, we're just going to log that as a delivery expense. It'll then come out of our profit, right? Because it's, subtracted out as an operating expense. Okay. So it's just remembering freight when you're the buyer, charge to inventory. When you're the seller, charge it to expense. Okay. And I think that's the main. Again, at the end of the chapter, they have some really good summary slides just showing you all the different journal entries. This is showing both from the seller and the buyer standpoint. So, again, I encourage you guys to print off those summary slides and just have them in your notes when you're doing homework or even the exam. It kind of just breaks it all down for you. So if you can remember if you're the seller or the buyer, then you know your journal entries, okay? Any questions so far? I know, again, it's a lot of new information. Yes, ma'am.
So is there another, like that chart that you printed out and gave us with the debits and credits on it? Is there another one of those charts that's been updated for like now? Because now I feel like there's a lot more
accounts.
And like sometimes I don't really know what side it goes on. Like, I don't know where it belongs to.
Right.
Which group, I don't know if it gets debited or credit.
It's not, there's not an updated one, because it's really just probably, you can always print that sheet and kind of write the accounts under it. So under assets, I would put inventory so you would know, okay, that's right, that's an inventory account. because I didn't do one. I just did the basic accounting equation.
Right.
So, but yeah, I encourage you though to go in, and use like this, for example, is a good one you could go off of. And any of the assets that you're not, new assets that you're not sure of, like just put them on that sheet. So then you're like, okay, inventory is an asset and sales is a revenue, customer refunds payable is a liability. Any that you're not like, oh, that's, an asset.
Yeah, like this is, like, I feel like that's what took the longest when I was like journalizing, because I didn't know
what account type it was.
Yeah, and I'd be like, I don't know where this goes.
Now on that, a lot of times you can look on the chart of accounts. So like this is the chart of accounts for Net Solutions.
Right.
So if you're in one of the blank sheet problems, and it should always have the chart of accounts, and so then it should list what type of account it is. So that can be helpful too, like print that off, and then you have that, and then you can use that with your other sheet. Like, oh, it's an asset. Oh, I debit it. Okay, yeah. Any other questions so far on chapter 5? All right. Well, let's have some fun, right, and do the exercise. So if you go out on Canvas, we're now in Unit 4, which is Chapter 5. You should see a Chapter 5 practice out there. Chapter 5 practice, which will say Canvas Engage. And hopefully we'll get through most of these. Just to kind of give you a preview of Chapter 5. Okay, so this first one is just talking about gross profit. And again, that's one of our big differences in merchandising, is that we now have gross profit. So on our income statement, we're going to take sales minus cost of goods sold. So that's your gross profit formula. So gross profit is always sales minus cost of goods sold. Here they're breaking it down, cash and accounts payable. Those are all sales. So you would add up the $18,300 cash plus the $295,700 for our total sales. Okay, good. Yeah, $314,000, and then you got cost of goods sold is $188,000. So what is my gross profit? Very good, $126,000. So again, gross profit is always sales minus cost of goods sold. So here we just had to add up cash sales plus accounts receivable sales. Okay, and then subtract out the cost of goods sold. So that one's a very easy one, but it's just understanding that's a huge difference in merchandising.
Well, the whole like putting this and that on like the whole on account thing, they can throw somebody off.
Right, exactly.
We had this one in like the Chapter 5 thing, something like that in house.
You're like, what are you talking about?
Yeah. And look, and it kind of did the same thing on the examples on what they just it all up.
Yeah, it can be easy, the wording, the terminology to mess us up. So yeah, a very easy formula, but very important in accounting. So sales minus cost of goods sold is gross profit. And again, that gross profit number is really important because that gross profit has to pay for all of our other expenses. Okay, so that's where we can kind of know, it's a good indicator. If our gross profit isn't high enough, then we're going to have a negative or a net loss because we're not able to cover rent and wages and, the millions of expenses that go along with the business. So, we won't get into it in this class, but in financial and especially managerial, you'll get into more of, why that's important when we're looking at product costs and setting sales costs and all of that fun stuff. But obviously, we're just learning the basics. And we're gonna take it step by step. But just to kind of give you a heads up, that's what you'll be learning in further accounting classes, things that are important. So here we're going to look at sales transactions. So here we're the seller. Okay, so we're selling merchandise. So in part A, it said we sold merchandise on account $92,500 with terms 1/10 and 30, and then it gives us the cost of goods sold. So again, every time we sell merchandise, there's 2 journal entries, and they've broken that down for you here. So the first one we recognize is always the revenue. Okay. So again, though, we want to recognize the amount we're going to receive. So we're going to take the discount up front. So in other words, yeah, we're going to take that 1% off. So if they pay us within 10 days, or that's a discount period, they're going to get a 1% discount. Okay. So again, there's
assuming that everybody has paid.
yes, yeah, there is a way to account for it when they don't pay the discount. But yeah, we assume that they're going to take the discount, and then if they don't, we deal with it when they pay.
Will it say that, like in the instructions? Will it say client paid past the 2 days or whatever, something like that?
Yes, or you'll just like if it's all within one, they'll give you the dates, and so you'll know. Yeah. So how much was the revenue or the sales with the discount considered?
91,525.
And what? 91,575.
575.
Yeah. It's like I'm sure you just read that wrong, right? So again, you can do that by taking 92,500 times 1% and then subtracting it off the 92,500. Or you could take 92,500 times 99 or 0.99, which is easier, but you just have to remember, you know. So that's the sales, that's the revenue we earned. So again, in this chapter, we're debiting sales directly. I'm sorry, why am I'm on the debiting? Accounts receivable. I'm losing my mind. I'm like, sales isn't on there. I was like, no, because you don't debit sales. Oh, I need more sleep. So we debit accounts receivable and credit sales. $91,575. So for the discount amount. And then the cost, again, we always debit cost of goods sold. And we credit inventory for the cost we paid, which they told us was $55,500. Okay, so that shows the inventory moving out the door. And then again, we could calculate the gross profit on this sale alone just by taking sales minus cost of goods sold. Okay, that would tell us the profit, the gross profit we made on that sale alone. The part B is just we received payment less the discount. So here they're telling us they paid within the discount period. Okay, so all we're doing is we're receiving what they owe us. So what would I debit and credit if they're paying their bill?
Payable.
Close. Accounts. They're paying what they owe us. So we sold them merchandise. We put it in accounts receivable, and now they're paying us. So what happens? We've already billed them, and now they've sent us the payment. So what would we debit and credit when they just send us the payment?
Cost of the merchandise.
Well, we log that here. Well, what are we receiving? Cash. There we go. I think you guys are overthinking it.
We were all way over.
Yeah, I'm like, no. I'm like,
There's an actual word that was not coming up.
These are accounts, but I was like,
I'm even like pulled down one and dropped down to try to look.
like everyone has a brain block, right? We're all like, accounts receivable is credited. So you debit cash and you credit accounts receivable. Like you guys are worrying me a little bit. I'm still like, no. Okay, good. Yeah, I think you guys are way overthinking it. We refunded $750 to customer for defective merchandise that was not returned. Okay, well, they've already paid their bill. Okay, so we're gonna pay them back in cash. And again, this one just goes into that customer refund payable. So that's just kind of a new one you just have to remember and learn. So when we give the customer a refund, we debit that liability account, customer refund payable, and credit cash. Okay. If this was before they paid us, we would credit their accounts receivable. Okay.
And so basically, that would have just taken $750 out of what they owe.
Exactly. Yeah. So then when we receive the payment, we would take what they owed minus that $750. Yep, you got it. Not too bad, right? It's starting to click a little bit. Except for receiving payment. I got it all right. Oh, come on. I gotta have some fun, right? Yeah, you should see the looks I get. Oh, what do you teach? Accounting. Oh.
I'm sure your students love you.
Yeah, exactly. And I'm like, but I like accounting. Oh, good times.
When you watch The Office, it makes you appreciate it a little bit.
Do I?
If you watch The Office, it makes you appreciate it.
Exactly. Yeah. Kevin. I just have to say, I feel like accountants are just wrongfully portrayed. Yes, thank you. Yeah, it's like every show you're ever on, they're like, oh, the accountants, they're like boring or like rigid.
The Office gives you all of those different characteristics that could be in that kind of a set. Even though it's like a paper company, it's still accounting.
Yeah, no, The Office is great. I love it. It's one of my favorites. But and just in general, though, we're watching something else,
Especially
and
if
they're
you've
like,
never
the
worked in
accountant.
an office like that.
Do I?
If you've never worked in an office like that.
I've worked in an office like that. My boss was not like Steve Carell, but
Yeah.
I don't think very many are.
Not made it that far.
Yeah. We had fun there, me and my husband, one day. We were just like talking about people that work here. And I'm like, that would be Steve. That would be Jim. It's like, fun to do. Just very fun. Even though we don't work in cubicles, you can still, like, you know, the personalities.
Oh, yeah, those traits and characteristics.
Okay, so the next one, we'll stop having fun since we don't have a lot of time. No, you're good. It's easy to get me off track. I'm like, oh yeah, let's talk about it. But we watch at night when we're like done watching, you know, just like chilling. I'll share one more thing and then we'll stop. My sister-in-law watches it like to go to bed at night, and she'll put her earbud in, and then she's like, I dreamed. Yeah, she's like, she falls asleep with it still in her ear. I'm like, that's a little too much. Like, I can't fall asleep with TV on there, so I don't know what that's like.
I don't know if I can fall asleep with Steve Brown's voice.
Right? Or just all of them. Like, there's so many different, like Dwight, and I don't know. Yeah, it's pretty funny though. I was laughing. Okay, but back to so now we're going to look at both the buyer and the seller, so that way you can see what the transactions look like on both sides. Because again, you know, if we're a merchandiser, we're obviously wear both hats, and so every company does. So we have Shore Company sold merchandise to Blue Star Company. So Shore Company is the seller, and Blue Star is the buyer. So they sold merchandise on account $112,000. Free on board at the shipping point, which we didn't really cover what those little lovely terms meant. So you can always remember in here, you can always mouse over to the freight terms. The buyer pays the transportation costs. So if you're ever in one of these and you don't remember what the term is, if it's in green, mouse over it and it'll tell you.
What does the FOB stand for?
It stands for free on board. And so what it means is if it's free on board at the shipping point, that means it's free when it's shipped out. So that means that the seller is not paying the shipping. That's why the buyer is paying. So you have free on board at the shipping point, the buyer pays. Free on board at the destination, the seller pays. So kind of like, yeah, they like to throw those tricky things into. So here's the buyer, but again, you can always just mouse over it and be like, oh, the buyer pays the shipping. We got it, right? Yes, yeah, free on board shipping point, the buyer pays the freight. Okay, so free on board shipping point, buyer pays freight. And then free on board destination, seller pays. And there is some more information in PowerPoint on that. There's a little bit more about it, but that's really all you need to know. So shipping point, buyer pays, destination, seller pays. Okay. So that's important because obviously it'll impact how we account for that freight. Okay. So in this case, the buyer, Blue Star, is going to pay the shipping. Our discount is 2/10, and then our whole credit period is at 30. They give us the cost of goods sold, and Shore has paid the freight, but since it's FOB shipping point, Blue Star is responsible for that shipping charge. Okay. So we want to journalize Shore Company, the seller, the sale, the purchase, and payment of the amount due. Okay. So, well, how do I log the sale? What would I debit and credit to sell merchandise on account? Very good. Very good. Accounts receivable to Blue Star Co. And what would I credit? Sales. Perfect. And how much would I debit and credit for?
Would it be the 112%?
Yes, you guys got it. So it'd be the 112 minus the 2%. So we recognize the discount up front. How much? Very good, $109,760. So again, that's taking off that 2% discount. Then we debit accounts receivable and credit sales. Okay. What's the other entry that I need to do when I recognize sales? There's 2 journal entries. What else? Very good. We need to recognize the cost of goods sold, and they give us that amount. So cost of goods sold is debited, and they told us it was $67,200. $67,200. And then we credit inventory, just to show that inventory is no longer there. So the first entry is always the sales. The second entry is always the cost to us. Okay, very good. The next one we're going to do is, they don't really tell us, but I'll tell you. We're going to invoice them for the freight. Okay. So if I'm charging them for the freight, very good. We're going to bill them. So it's accounts receivable Blue Star for the $1,800. And it said we paid it. So what do you think we'll credit?
Transportation now.
It's a good guess. Cash. Yeah. Since we paid it, we're just going to go ahead and credit cash. So we're billing them for it. We already paid it up front. So we're going to invoice them, and then they're the ones responsible for accounting for that freight charge. And so we'll just credit cash. Okay. If we, the buyer, were paying the freight charge, that's when we would debit like delivery expense or freight expense or something like that. And then the last entry is just them actually paying their full bill. So what do I debit and credit when they pay us the bill? What accounts first and then we'll do the number? Cash. Okay. Like, it's not a trick question. Notice I asked with a straight face though.
Right.
Credit, like, I was like,
come on, we get there, cash.
Like,
back and forth.
yeah. well. They couldn't figure out cash, so I may have said some things. Yeah, maybe threw a thing, something. I don't know what happened. And then what would be credit?
Accounts payable.
Counts
Or receivable.
receivable.
Sorry.
Yeah.
Yeah.
Oh. How much are they paying us?
All of it.
All of it.
Well, no, it'd be the 109 plus the 80.
You guys got it. Very good. So they owe us the original, the inventory amount plus the freight because we debited their account twice.
111,560.
Very good.
But if it didn't have that FOB shipping point thing, would we just assume that?
They'll always give you if there's freight, they'll tell you one or the other.
But if it was the other way around, then we wouldn't have included it.
Correct. The difference would be this entry would have been like delivery or freight expense,
Okay.
and then this just would have been the 109,760. Yeah. Very good. I'm feeling better now.
Oh, yeah.
Are y'all feeling better about
Cash.
it? Yeah, cash. When in town.
Cash.
That's what makes the world go
That's all I got. That's all I got.
Hey, if all you got is cash.
Yeah.
Oh, we needed levity, right? Blue Star Company. So now we're journalizing Blue Star. So they're the buyer, right? They're the one purchasing this inventory. So when they purchase the inventory, what would I debit and credit? Very good. Accounts payable gets credited, right? What gets debited?
Merchandise
There
inventory.
you go.
Receiving merchandise.
Yeah, there you
I'm
go.
not looking at the options, so.
Yeah, inventory. So when we're the buyer, we're purchasing inventory, which is your asset, and then we owe accounts payable. And here on the amount, they could be a little more clear, but we're invoicing them. Like, sure, invoice Blue Star for the total amount.
But not
So-
discounted.
Well, the discount, but also
With the
including
shipping.
the freight.
So
Yeah.
it'd be the 111.
So I thought I'd point that out because that one's a little tricky. So when we're looking at it, it's all on one invoice. Okay. 111. So that's the total amount. So again, all of those costs go into inventory. The shipping cost gets added into inventory because it's part of the cost of getting that merchandise. Okay. So and then they're gonna, charge the customer for that. So make sure it's costed into the inventory cost. And then what happens when we pay it? So we're now Blue Star and we're paying our bill. So what do we debit and credit? Payable, good. Accounts payable for Shore Company gets debited, and what gets credited?
See them options.
There
See them options.
you go, ding, ding, ding. Cash. And again, it's just the full amount, the full bill, because we took the discount off the top and the freight is included. So that deals with both the seller and the buyer, so you can see both sides. The only thing we didn't deal with was like a refund or, like a return, but you're still seeing all of it.
I hate that check my work button is
Right.
Yeah, I
I
wish
really
you
look
could click
for
it
it a
every
lot.
once in
I
a while, and I'm
look
like,
for
oh wait, it's not there.
You're like, darn it.
I'm like,
Honestly, I wish they would allow us to like turn it on certain questions. Like we either turn it on for the whole exam or not at all. But it would be kind of nice to like give you one check my work on like
Right.
the exercises, just to kind of, okay, either you're way off base or hey, I've got that confidence that I'm right.
well, like with the ledger, like even just like reading those little tiny like italicized sentences that they put in there, like for instance, I didn't
Yeah.
know if I wouldn't have read it that in order to do that, check my work on like the journal.
That you have to
I had
journalize.
complete the
Mhm.
entire page, and I didn't know that until I started like getting, into it really, and then it was actually the second page that I saw it come up on.
Oh,
And I was like,
You're like, oh.
how am I getting this? And then I read it, and I was like, oh. That's
Good times, right? Make you do a lot of work.
Give you all of your innards.
Counting's fun.
It's not bad.
See, I'll take it.
There's worse.
Yeah,
Yeah, I
definitely.
agree. I'll take it. I'll take
I have
it.
2 kids in diapers. Accounting's nothing.
You're right.
Whatever.
Whatever. The last two we're going to look at is really just comparing what we call a single step income statement to a multiple step income statement. It sounds a lot harder than it really is. So single step is what we're accustomed to, where we just take revenues minus expenses. Okay. So in this one, we have custom wire and tubing. They tell us, all the different costs and revenues. So we have 2 revenues, rent revenue and sales. So I always list my highest revenue first. So I'm going to start with sales. 9,332,500. 9,332,500. This is similar to the income statement you did on the project or in chapter 4. And then the rent revenue is 60,000. I have kids, I have good hearing. Whether I like it or not. So then we just add up, of course, our total revenue. So yeah, 9,392,500. 9,392,500. And again, with our single step, we just list all of our expenses from biggest to smallest. So they give us all of those up here. So cost of goods sold is an expense. Okay, so I'm going to list it first. Cost of goods sold is what, 6,100,000. 6,100,000. Then we have selling expenses of 1,250,000. 1,250,000. Administrative expenses of 740,000. 740,000. And then interest expense of 25,000. 25,000. So obviously it kind of guides us too, but the next thing is just to add up our expenses. And for time's sake, that is 8,115,000. 8,115,000. And then the last thing we do is take sale or total revenues in this case, total revenues minus total expenses. Okay. To get our, what will that be?
Net income.
Very good, net income. Okay, and you should get 1,277,000. Was it 500? Mine's cut off. Am I gonna have to do the math?
That should be right.
1,277,000.
Yep, it is.
Okay.
Only because check my work said so.
Right? We're good. I'm like, mine cut off after the 7. I'm like, well, but there's 5 there, so we have to have 5 there, 500 there. Okay. So again, that's just a review. That's what we're used to, revenues minus expenses. So you can check that one. So if you click on next, our last one is they give us all the accounts, but we're doing a multi-step income statement. So for merchandising companies, they're going to use multiple step income statements. And the reason is really what we're breaking it down is we're calculating and showing the gross profit. Okay. So again, gross profit is sales minus cost of goods sold. So we're showing gross profit and then we're subtracting out all the other expenses. So it's really not difficult. It's just in a different order. Net income is going to be the same whether you do single or multiple step. Okay, it doesn't change your net income. So on this, I'll just give you the numbers, but we always start with sales, which is our revenue. So sales in this case is our only revenue account. So it's sales, and it is $8,245,000. $8,245,000. And then we're going to subtract out cost of goods sold. Yeah, very good. So cost of goods sold is our next one. I like to show it as a negative just because we're subtracting it out. So I would do minus $5,500,000. Minus $5,500,000. So that was the cost of all the merchandise inventory that I purchased and then sold. That was my cost. And so then I just subtract to get my gross profit. So gross profit is $2,745,000. $2,745,000. Okay, so we just have that extra step in there of calculating gross profit, which again, if we're a merchandising company, is important. We need to know gross profit is one of our biggest numbers in a merchandising inventory, which, as I mentioned, you'll learn more about in really managerial accounting, but even a little in financial. And then we're going to list expenses. What we do in a multi-step, which is a little different, is we just categorize expenses as selling and administrative. So we're only going to have two types. We're just going to put all selling expenses as a selling expense. So that's kind of the trickiest part. So we're going to have selling expenses and administrative expenses. Okay. So to give you an idea, selling expenses are going to be like advertising, your sales salaries for like sales managers and salesmen, delivery expenses, okay, anything associated with the sale of the product. So advertising, commissions, salaries, anything like that, depreciation on the actual equipment that helps sell. Okay, so all of those added together, which they just told us up at the top what the selling expenses were, so you don't have to really know. Yeah, so go ahead. Yes, $575,000. So it's just good to kind of understand what selling expenses are, but really we'll get into that in the managerial accounting where you'll learn how to break them down. And then administrative expenses. And again, and they give you those, $435,000. But administrative expenses are everything dealing with the office itself. So like, you know, do I?
Supplies.
Yeah, supplies are a great one. The office salaries for like, you know, the office assistant or manager and, you know, all of that. Usually management salaries fall under there too. Rent, insurance, supplies, all of that kind of falls under administrative. So if it's not directly tied to the product, basically. So all of that goes into administrative, and we add those up, and you should get $1,010,000. So 1,010,000. And then the next line is going to be income from operations. Income from operations. So we're going to take gross profit minus selling and administrative expenses, or minus total expenses. And that gets us income from operations of $1,735,000. $1,735,000. You notice there's still some more places here though, right? Well, we're going to take interest expense out because it's not an operations expense. Okay, so interest expense kind of gets taken out at the bottom. Okay. You may also see when you get further in accounting that it would be like taxes, you know, any taxes that we owed or paid would also come out of here at the bottom. So that's $15,000. So then we get net income. We take our income from operations minus interest expense, $1,720,000. So they'll give you the selling and administrative. They'll give you all the expenses. You just kind of have to know the structure. So it just changes a little bit. And again, that's because merchandising inventories operate differently. So when we go, you know, the person performing this or running this report may not be, but someone else is analyzing it and trying to figure out ways to cut costs. So it's about how they want it broken out. Okay. So it says, what is a major advantage of multi-step income statement over the single step? Really, again, the biggest is you're showing gross profit. Do it. Is that what you were going to say? Yeah. So the biggest difference is you're showing the relationship of gross profit to sales, which again, in financial and in managerial, you're going to learn more about why that's important. But yeah, gross profit is a big, important part of merchandising. The price we're paying for stuff versus the price, our sales price really drive our profit. And of course, if you've taken any marketing or anything like that, we know there's a lot more that goes into it than just the accounting side. That's why, honestly, just to give you kind of a preview, part of accounting is setting up budgets and goals. And so it's everyone, marketing, management, accountants, everyone, all the high-level VPs or high-level executives get together and set like a sales budget. And then everything rolls off of that. Okay. So it does take, obviously, the whole team, the whole company to come up with that because there's so many perks. We won't get into all of that. But we know if you've taken marketing, there's demographics and economics that play a part. All of it plays a part. Everything. So, but we as the accountants we either provide the data or we analyze the data. We don't get into those. We're like, you marketing folks, do what you need to do. You economists, just let us know what we need to know. Any questions so far? Okay, so I think I changed it on Cengage, but if not, I will. Your Chapter 5 homework will be due next Wednesday. Just in case you have questions, we can address those in class before you finish your homework. So work on it, bring your questions, or obviously you can email me in the meantime or come see me. But otherwise, if you have just a couple of small questions, you can bring those next Wednesday, and we'll just kind of go over Chapter 5 to get you prepared, make sure you're ready for the Chapter 5 exam. These chapters flow a little quicker because they're a little more, direct. So hopefully you guys will be okay.
Definitely less broad. Yeah, like you said, direct.
We're only focusing on merchandising, so it should be. Obviously, you're still using what you learned, but it's a little bit easier. So yeah, be working on Chapter 5. I will see you next Wednesday. Have a great weekend. Hopefully, it looks like decent weather.
Tomorrow's supposed to be raining this day.
Well, it's hotter on the weekend.
Okay.
I got bagel juice.
You did what?